Welcome to this explainer. Imagine you're running the biggest physical retail business in America. You're literally pulling in billions of dollars in a single quarter. But then, you suddenly abandon a payment strategy you've stubbornly clung to for years, right as your stock takes a shocking nosedive. Sounds crazy, right? Well, today we're unpacking the Walmart paradox. What in the world is actually going on behind the scenes? Let's get right into it. Okay, let's dive into this. $187.9 billion. That is Walmart's total revenue for just the second quarter. It's up 5.9% year over year, which firmly establishes their absolute dominant scale in the retail world. I mean, looking at the broad strokes, business, at least on the surface, is absolutely booming. But then, literally one single day after releasing those massive earnings, bam, a staggering 9.2% one-day collapse in their stock price. You've got a huge revenue beat on one hand and a massive stock drop on the other. It's this wild paradox that had investors and analysts completely reeling, scrambling to figure out what they missed. Which leads us to the ultimate question we're answering today. Why change a winning strategy now? For years, Walmart essentially walled off their checkout process to push their own proprietary app. So why would a company making billions suddenly abandon its tightly controlled payment ecosystem just as the market panics?
Section 1. The 9% stock shock. Looking under the hood.
To understand the panic, we really have to look beneath the surface of this financial iceberg. At first glance, Q2 results look incredibly strong. Total revenue is up 5.9%. Operating income up a seriously impressive 28.8% to $9.38 billion. Adjusted earnings per share sat comfortably at 81 cents, and they generated a massive $5.5 billion in cash flow. Those are phenomenal metrics, no doubt about it. But the crucial thing to remember here is that these numbers are entirely backward-looking. Wall Street wasn't reacting to yesterday's success, Investors were spooked by something lurking in the future. Section 2. The changing American consumer. Behavior is shifting. That forward-looking fear really centers on a distinct, undeniable slowdown in how shoppers are actually spending their money in the aisles. And this brilliantly illustrates the complex financial headwinds Walmart is facing with U.S. comparable sales. Just look at the trend. In the previous year, growth was sitting at a very healthy 4.6%. Analysts expected a slight dip down to 3.8% for this quarter, but the actual number? It came in at just 2.6%. The growth in physical stores is cooling off much faster than anyone anticipated. So what's actually driving that slowdown? Well, several major consumer pressures are at play right now. Higher gasoline costs, tightening household budgets, stubborn food prices, and some complex changes in healthcare and pharmacy spending. Now, Walmart's actual transaction count did grow by 1.5%, meaning people are definitely still walking through the doors, but they're becoming incredibly selective once inside. In fact, that 2.6% growth figure we just talked about actually included an 80 basis point headwind directly from health and wellness categories. Across the board, everyday shoppers are definitely pulling back. But the metric that truly solidified Wall Street's panic? 3.0 to 3.75%. That is Walmart's net sales growth outlook for the third quarter. It's noticeably slower than Q2's 5.9% growth, and this is the absolute biggest forward-looking risk. Remember, the stock market is a discounting mechanism, right? Investors pay for what they believe a company can earn tomorrow, and Walmart is clearly signaling that tomorrow might be a whole lot slower than today. Section 3. The digital retail surprise. A massive, unseen shift. Right when those physical store numbers start looking a bit grim, we uncover this fascinating structural change happening right beneath the surface. So the crucial point is this enormous number, 23%. That is exactly how much Walmart's global e-commerce sales jumped in the very same quarter. This digital surge contributed an incredible 510 basis points, or 5.1%, to their U.S. comparable sales. So while the traditional brick-and-mortar business is showing distinct signs of moderation, their digital side is absolutely roaring. To truly wrap your head around the scale of this digital engine, consider this mind-boggling fact. Walmart generates approximately $2.05 billion in revenue every single day. I mean, at that massive scale, saving even a single second of friction at the checkout line is worth millions of dollars. Checkout speed isn't just some minor convenience for the customer. For Walmart, it's an absolutely critical lever for sustained growth, operational efficiency, and deepening that digital engagement. Section 4. The Apple Pay pivot. Removing friction. So how does a massive retailer actually remove that physical friction and hook shoppers into their digital engine? Well, they change course with incredible speed. For years, Walmart essentially blocked Apple Pay and Google Pay, strictly requiring customers to use Walmart's own digital tools. But starting August 24, 2026, select Walmart and Sam's Club locations begin accepting Tap to Pay. By the end of 2026, it's going to roll out to all U.S. stores. And by mid-2027, this frictionless payment reaches their fuel stations, which is a place where customers demand the absolute fastest transaction possible. Tap, pay, leave. Every second counts. This represents a massive, and I mean massive, philosophical shift for the company. They're moving from this stubborn, use our payment system mentality to a highly flexible, use the payment method you prefer strategy. Now, Google has even confirmed shoppers can add their preferred card to Google Wallet to just tap and pay. Now, to be clear, Walmart isn't killing off their own Walmart Pay app, but they are finally acknowledging that they can't force the customer to choose between convenience and Walmart's proprietary system anymore. Section 5. The ultimate ecosystem battle, beyond the checkout. But why cede that control to Apple and Google right now? Let's move along and see how this builds a complete picture of customer control. In the modern retail ecosystem, it all starts with the payment. That payment captures essential purchase data, which then builds a broader customer relationship. That relationship links seamlessly to the Walmart app, generating personalized offers which, you guessed it, directly drives future purchases. The physical payment itself is only the very first piece of the puzzle. By giving customers the absolute fastest payment option, Walmart completely removes the friction that stops people from entering this multi-billion-dollar digital advertising and membership machine in the first place. Think about the titans of retail for a second. Amazon won the internet shopping battle by ruthlessly removing online friction. Search, click, buy, deliver. Walmart is now taking that exact same playbook and applying it to physical checkout friction. Tap, pay, leave. Simplicity at the checkout is Walmart's new major competitive advantage. They already have the physical stores within miles of almost every American, and now they finally have the frictionless entry point to match. It's a real game changer. So we started out by looking at a 9% stock drop and a consumer who is slowly but surely pulling back on spending. But the real story is what Walmart is aggressively building behind the scenes to counter that. The ultimate question isn't why they finally accepted Apple Pay. The real question is, will Walmart become the world's biggest digital ecosystem? By merging their enormous physical footprint with a high-speed, frictionless digital checkout, the next chapter of Walmart's story might not be about being a traditional supermarket at all. It might just be about owning the entire modern shopping routine. I'll leave you to ponder that massive shift. Thanks for joining us for this explainer.